Welcome to this video on Operation 9 Lives. We are examining whether current market conditions represent a dead cat bounce, or the start of a more significant trend during what is being called the biggest earnings week in 5 years. This video breaks down the current battlefield. We look back at the recent semiconductor crash and the resilience of energy stocks, while also analyzing upcoming earnings from major banks and TSM, which will set the tone for the hardware cycle. To understand the market, we rely on 3 pillars: macro, fundamental, and technical analysis. Our goal is to stack this evidence to follow actual market flows, rather than reacting to headlines. We are facing the most important earnings window in 5 years. With extreme valuations and key technical levels for the S&P 500, there is very little margin for error, making every data point critical. Moving to our first pillar, macro theater. We are operating in an environment defined by a new Federal Reserve approach, a midterm election year, and a market characterized by record high leverage and low cash. A significant development this week is the Fed's new focus on artificial intelligence. By forming specialized task forces, the Fed is now incorporating AI productivity and CapEx into its official policy deliberations. This new Fed regime represents a shift in the rules of engagement. Investors should expect increased policy uncertainty and higher volatility as the market adjusts to how the Fed processes these new tech-aware inputs. Historically, midterm years are prone to volatility. While the first half of July has been constructive, we are approaching the period between August and October, which has historically been a time when market turbulence increases. While current price action aligns with a mid-July bullish window, the real risk lies in the post-earnings environment. We emphasize trading the data and flows, as historical signals are not precise timers for market moves. Retail investor cash allocation has reached extreme lows, suggesting that the marginal dip buyer is already fully invested. Similar signals are seen across fund allocations, which historically precedes periods of higher volatility. The current market environment is defined by widespread leverage, with leveraged single-stock ETFs becoming a major component of retail trading. While these regimes can persist, they are often a hallmark of late-cycle behavior. Warren Buffett's long-standing cash accumulation at Berkshire Hathaway indicates a disciplined adherence to value. While appearing early, this defensive posture mirrors classic late-cycle positioning, where smart money pulls back from stretched valuations. We are currently seeing a high number of Hindenburg Omens signals. It is important to remember these are not timing tools but indicators of fractured market breadth, which should be added to your overall evidence stack. Our macro verdict is that we are in a late-cycle phase. We see both bullish tailwinds and bearish warning signs, leading us to recommend respecting the uptrend while remaining cautious and reducing size into binary events. This concludes our summary of the second pillar, fundamental recon. We turn our attention now to how earnings results and credit markets will shape the next phase of our market analysis. Let's look at the earnings week battle map. Banks kick things off on Tuesday, while TSM's earnings on Thursday serve as the main event for the semiconductor cycle. We also have Netflix reporting after the close on Thursday. The options market is pricing in significant moves. Notably, TSM at only 6.5% implied move looks low given what is at stake. Meanwhile, banks are pricing in major pre-open swings, and realized volatility exceeding implied is the prime ground for 0 days to expiration trading. On Tuesday, we will watch the banks for critical insights. We are looking at credit health through loan losses and provisions, debt appetite to see if liquidity is still flowing, and the technical setup for the financial sector, which is positioned for a major reaction. Thursday's TSM print will dictate the hardware cycle. With an implied move of 6.5%, there is a lot of potential impact. We are watching for clarity on AI capital expenditure durability, as this affects the entire semiconductor complex. Taiwan's market is highly concentrated in TSM, making their earnings report a national and global index event. How TSM performs this Thursday will likely set the tone for the Kospi, SOXX, and the Nasdaq. The recent Samsung earnings report provides a cautionary tale. The market can sell into even a great print if it's already priced in. In this environment, we must trade the reaction on the second candle rather than just the headline. Netflix reports Thursday after the close, with an implied move of 7.87%. This is the largest move on our list, indicating that the market expects significant volatility for this beaten-down name. Looking at debt, Amazon recently raised $25 billion. While slightly oversubscribed, it confirms that the debt window remains wide open for megacap issuers, showing that liquidity is still available for those who need it. The recent SKH listing was 7 times oversubscribed, marking a historic moment for foreign corporate listings on Wall Street. This continued institutional demand for new deals suggests that capital is still aggressively looking for deployment. The key question is when the liquidity tap will finally close. For now, the appetite for risk is robust. We are monitoring issuance and credit spreads as our early warning radar for when this cycle begins to turn. Contrary to some narratives, the forward price-to-earnings ratio for the S&P sits within the mid-band of the last decade. The real bubble risk lies in high concentration and excessive leverage, rather than valuation multiples alone. There is a massive divergence between bullish analyst upgrades and the recent market price action. This gap often appears in speculative bubbles, and it suggests that while sentiment remains optimistic, the price tape is growing increasingly nervous. To summarize, liquidity is still roaring, but the earnings bar is set very high. While valuation multiples are moderate, the spread between analyst sentiment and the price tape is wide, requiring caution until we see confirmed moves. Now we shift to Pillar 3 technical warfare. We will examine dead cat bounces, the critical levels defining this week, and the rotations beneath the surface of the market. We've seen a sharp crash in semiconductors followed by a relief bounce. This setup is classic for a dead cat bounce, where liquidity pulls in for a short-term trade before the trend potentially resumes its previous downward direction. The KOSPI index serves as a primary global indicator for the memory and hardware sectors. It is currently pinned near critical support levels, waiting for the news this Thursday. If these supports hold, it could suggest a recovery, but failure here would act as a trigger for a broader global decline. We have seen $5.4 billion flow into semiconductor ETFs in a single day. While this signals strong interest, it is not proof of a bottom. We need to see structure, such as a higher high, to confirm if this represents genuine conviction or just exit liquidity. In the semiconductor complex, 600 is the key level for all expirations. If we drop below, the resulting gamma pressure could create a waterfall effect, accelerating selling. Holding above this level is essential for maintaining a floor in this sector. For the S&P 500, 7,600 serves as the current call wall and resistance zone. We have seen significant open interest at the 7,560 to 7,600 range. With all-time highs within reach, the market is currently caught in a battle between these call barriers and lower-level put supports. The QQQ is trapped in what we call the pit, ranging between 700 and 730. The 700 level acts as a firm put support, while 730 represents the call wall. We are waiting for a definitive daily close outside of this range to set the direction for July. Despite some carnage in the hardware sector, the broader market remains healthy. Equal-weighted indices and advanced decline lines are rising, and the Magnificent Seven have posted new highs. Under the hood, the market is showing resilience. Energy is proving to be a stealth leader. Nearly 9 out of 10 stocks in the sector are outperforming the S&P 500 year-to-date, even while oil prices remain near the lows. This divergence often indicates that the market is beginning to rotate toward overlooked opportunities. There is a notable divergence between spot oil, which is down significantly, and the March 2027 futures contract. While spot prices are suppressed, the back of the curve suggests a higher-for-longer outlook, which the energy stocks are beginning to anticipate. While retail investors focus on the spot price of $57, professionals are watching the forward curve at $69. The emergence of a higher high in energy stocks marks a potential shift in the sector's trend. We are closely watching the Strait of Hormuz and other geopolitical flashpoints. Markets often use these existing tensions as excuses to move during key technical moments. If oil spot prices reconnect with the futures curve, we expect a violent move in energy-related groups. Gold is holding the 4,200 level, although it remains below its 20-day moving average. Silver has seen a collapse in ETF flows since January, which often sets up a contrarian play. Meanwhile, the dollar remains strong, acting as a headwind for the metals complex. In the crypto space, Bitcoin is stabilizing around 66,000, which is helping to base build despite negative sentiment. Ethereum is also potentially forming a double bottom. Stability here reduces the pressure on overall market liquidity. On your screen are the critical levels to watch this week. SPX resistance at 7,600, semiconductor support at 600, gold pivoting at 4,200, and Bitcoin holding 66,000. These are the primary benchmarks that will define the market's trajectory. Our rules of engagement for this earnings week are to prioritize data over headlines. Treat semiconductor bounces with caution until confirmed. Stay within the binary levels of 7,600 and 600, and keep a close eye on the rotation into energy as a potential flow-driven trend. That completes the Operation 9 Lives debrief. Remember, trade the facts, not the narrative, and keep your risk management tight. For more insights, follow our channels on Substack, X, and YouTube. Good luck this week.